Three men walk into a room in New York. One bets that interest rates will go up. Another bets they'll go down. The third guy doesn't care either way. He's betting that both of them are wrong for completely different reasons. None of them touch a single dollar bill. Nothing physical changes hands, and yet, in that room, they can create financial contracts worth billions of dollars in minutes. Now, multiply that behavior across thousands of banks, hedge funds, pension funds, governments, corporation trading firms around the world, and you arrive at a market so large, so abstract, that even the number barely sounds real. $1 quadrillion. That's 1,000 trillion, more money than exists on Earth, more than the global economy, all the stock markets combined. Markets so enormous that when people first hear about it, they usually assume the number is fake, but it's real. And most people have never heard of it. It's called the derivatives market. And despite sounding like something invented by a sleep-deprived math professor, this invisible system quietly influences mortgages, retirement accounts, food prices, oil prices, interest rates, currencies, and occasionally, the stability of civilization itself. The strange part? Derivatives were originally supposed to make the financial system safer. Instead, they may have made it impossible to fully understand, because modern finance stopped being about money a long time ago. Now, it's mostly about bets on money, and sometimes bets on whether the original bets will fail, which is either genius or deeply concerning. Probably both. To understand how we got here, you have to go back hundreds of years. Not to Wall Street, to farmers. Imagine you're a wheat farmer in the 1800s. You spend months growing crops, but there's one problem. You have no idea what wheat prices will be when harvest season arrives. Maybe prices crash, maybe they rise. Your entire future depends on a number you cannot control. So eventually, farmers and buyers came up with a simple agreement. A contract. I'll sell you my wheat 6 months from now for this price. Now the farmer has certainty. The buyer has certainty. Everybody sleeps better. That contract was an early derivative. Its value was derived from something else. In this case, wheat. Simple. Useful. Almost boring. Then, finance got involved. Finance has a remarkable talent for taking relatively normal ideas and turning them into deeply complicated systems with extremely expensive consequences. Over time, derivatives expanded beyond crops. Oil, currencies, interest rates, stocks, debt, weather. There are literally financial contracts tied to rain, which sounds ridiculous until you realize airlines, farms, and energy companies can lose billions because of unusual weather patterns. So the idea spread everywhere. If something can change in value, someone will eventually bet on it. And once computers entered the picture, the market exploded. Because derivatives allowed institutions to do something incredibly attractive: control huge amounts of financial exposure without actually owning the underlying thing. Let's say you think oil prices will rise. You could buy actual barrels of oil, which would be inconvenient unless your apartment has room for industrial storage tanks. Or you could buy a derivative contract linked to oil prices. Much easier. This is where the numbers start becoming absurd. A small amount of real money can control gigantic positions, which means profits can become enormous. But losses can too. And that's the hidden mechanism underneath modern finance. Underneath modern finance. Leverage. The financial equivalent of using a flamethrower to light a birthday candle. Efficient, but potentially catastrophic. Banks loved derivatives because they appeared to spread risk. Investors loved them because they amplified returns. Governments tolerated them because the system kept growing. And for a while, everyone looked smart. Then 2008 happened. The global financial crisis is often explained as a housing crash. It wasn't just a housing crash. It was a derivatives crisis wearing a housing costume. Banks had created mountains of mortgage-related derivatives, Complex chains of financial products built on top of home loans, then products built on top of those products, then insurance contracts on whether those products would fail. By this point, finance had become less like banking and more like an enormous tower of interconnected promises. The problem with interconnected promises is that when one breaks, everybody suddenly wants to know who owes what to whom, and nobody fully knows. That's the terrifying part. Even inside the system, visibility became blurry. When housing prices started falling, panic spread because institutions realized the risks weren't isolated. They were connected everywhere. A pension fund in Europe could be tied to mortgages in Nevada. A bank in Germany could be exposed to debt in Florida. The entire system resembled a giant spider web built out of leverage and optimism. Then the web started tearing. Lehman Brothers collapsed. Credit markets froze. Governments panicked. And suddenly taxpayers around the world were rescuing financial institutions whose products most people couldn't even explain. Which is a strange feature of modern capitalism. If normal people fail financially, it's called responsibility. If giant institutions fail financially, it's called systemic risk. Now, after 2008, regulators promised reforms, more oversight, more transparency, less dangerous speculation. And to be fair, parts of the system did improve. But the derivatives market never disappeared. Even if you never trade anything in your life, derivatives still affect you. Today, derivatives are everywhere. Companies use them to hedge risks. Banks use them to manage exposure. Governments use them to stabilize borrowing costs. Pension funds use them to chase returns in a low interest rate world. Even if you never trade anything in your life, derivatives still affect you. Your mortgage rate? Connected to interest rate derivatives. Your retirement account? Likely exposed through institutional investments. Food prices? Energy costs? Currency fluctuations? All touched by derivative markets somewhere in the chain. Which raises an uncomfortable question. If this system is so dangerous, why does the world keep using it? Because modern finance has a problem. The global economy is now too large, too fast, and too interconnected to function without risk transfer systems. Derivatives became the plumbing underneath globalization. And like plumbing, nobody thinks about it until something starts leaking through the ceiling. The defenders of derivatives argue that they reduce uncertainty. And sometimes they do. Airlines hedge fuel prices. Businesses protect against currency swings. Farmers lock in predictable income. Those are legitimate uses. But speculation changed the scale completely. Today, many derivative trades have nothing to do with real economic activity. They're simply financial actors making bets against other financial actors. A giant ecosystem of prediction, hedging, arbitrage, and leverage. Money orbiting money at extreme speed. And here's where the $1 quadrillion figure becomes misleading. Not all of that represents real money at risk. A lot of it overlaps. Many contracts cancel each other out. Financial institutions love pointing this out. Technically, they're right, but that explanation also hides something important.
In tightly connected systems, even smaller failures can spread violently if trust disappears. Because modern finance ultimately runs on confidence. Confidence that contracts will be honored. Confidence that banks remain solvent. Confidence that liquidity will exist tomorrow morning. And confidence is strange. It can take decades to build and a weekend to evaporate. That's why central banks now monitor derivatives markets obsessively, because they understand something most people don't. The real danger is not just losses, it's contagion. The moment institutions stop trusting each other, financial systems can freeze with shocking speed. And in a world where economies depend on constant flows of credit, debt, and liquidity, a freeze can become existential.
which means the largest market on Earth is also one of the least understood by the public, an invisible architecture holding up global finance. Mostly functioning, occasionally terrifying, and growing more complex every year. The strange irony is that derivatives were invented to create certainty, but at the highest levels, they may have created a world so interconnected that nobody can fully predict where the next crack will appear. And maybe that's the real story here. Not that modern finance became too big, but that it became too abstract. A system where trillions of dollars move through contracts most people never see, affecting the lives of people who never agreed to participate. Which leaves one uncomfortable question. If the global economy now depends on markets almost nobody understands, what happens the day those markets stop understanding themselves?
If you enjoy documentaries that uncover the hidden systems shaping money, power, and the global economy, subscribe to the channel. Because the most important financial stories are usually the ones nobody explains.